Welcome into a brand new episode of WSI TV. Enjoy the show.
Hi guys, welcome back to WSI TV. Today we're doing another episode of Informer Spotlight. I am Tayler Klinkbeil and I'm joined by Leah Warren. How are you doing, Leah?
I'm doing great. How are you, Tayler?
I'm very good. Today we're going to be doing something very interesting for you guys. It's kind of a back to the basics. If you're new to the channel, or maybe you've just subscribed, or you're just now trying to get into finances and you're not sure if you want to subscribe yet, we're going to try to lure you in a little bit and show you the different ways that we approach investing, the ways that you can kind of organize yourself to be more successful when you do get into it. But before we do that, I do want to remind you to go to WSITV.com. There you get instant access to our daily newsletters, and you get into the WSI Vault. So if you're brand new to investing, that is a really great resource to start at. And of course, always come back to the channel and subscribe to the channel to see our weekly updates. But without further ado, we're just going to get straight into it. We're going to talk about organizing your finances and why it's so important.
Yeah, so this is all about the details. We've obviously talked to you guys about how to pick out stocks and just about different sectors that you can get involved in. But like Tayler said, this is back to basics. This is how you keep track of all of that. We've even shown you how to look for a strong stock, but we haven't necessarily told you how to keep up with that stock. So that's what we're going to talk about today. So one of the biggest sources of stock market losses is the lack of a clear system of tracking investments. So people will purchase a stock and they'll just have it in their portfolio and they won't keep track of it. And in the meantime, it'll be losing ground. And then someone will remember to check it and they'll realize that they've already lost that ground and they'll panic and hop out and lose a bunch of money that they could have recovered.
Exactly.
So this is all about having a system and keeping to that system and making sure that it works for you so that it's easy for you to keep track of everything, because it can get complicated. One of the biggest rules is to diversify, but with diversity comes a lot of things to keep track of. So the first thing that you want to do is keep a stop loss.
Yes.
So you've probably heard us talk about this before. Just back to basics, what is it? A stop loss is an automatic trigger price that signals that your investment has dropped too low and it's time to get out. So we usually set our stop loss between 5-10% depending on what we're getting invested in. And all of that, just again, it's dependent on the sector, it's dependent on the stock. But you want to set it so that your loss isn't so large that you aren't recovering any of your initial investment.
Yes.
So you don't want that stock to drop back to zero and then you just wait it out and hope that it's going to rise up again. This is a way of removing your emotions because you just automatically have this rule of at that number, whatever you decide it should be, you're going to cut your losses and get out.
Exactly.
And the rules for setting a stop loss can vary a lot, but make sure it isn't too far below your investment amount because the idea behind it is that you are not losing your entire investment.
Yeah, I mean, this is kind of important to think in terms of, you'll hear kind of generic advice out there about your risk tolerance and the things that you can stomach, for example, but that may not necessarily be the best way to approach this. We did say that your stop loss can vary based on the stock or the sector or what have you, but I think in the sense of you shouldn't look at the chart when you're picking out, or when you have found a stock and you want to invest in it. It's not looking at, okay, how much can I stomach if I were to lose it? It's not looking at, will this hurt coming down on the backside? Like, well, your eyes are often bigger than your stomach in terms of that. So you don't really want to set that for yourself on this arbitrary goal that, oh, I'll be fine. It's okay if I lose X amount of money. You should really make sure, and to keep your emotions out of it, make sure that you have a set hard deadline that, for example, we often use 5% because you have that mindset of, if I lose $1, okay, I sit back and I wait, and then later you make 10. But you can't make 10 if you continue to lose $5 and $6 and $7 incrementally every single trade that you're making. So you do have to be consistent, and you do have to make sure that you're following your own rules that you set out for yourself and determining what those are before you even get started.
Absolutely. One of the biggest mistakes is that someone will set a $1 stop loss or something similar where it's like, okay, I can stomach losing $10. But if you're getting in on a $300 stock, then it's going to drop. It's going to fluctuate.
Yes.
Some other important things with stop losses is you can have an automatic stop loss or a manual stop loss. A lot of people will recommend using an automatic. We actually say not to because there's a little bit more kind of expectation that you keep up with your finances if you have to manually watch it. Plus, a lot of automatic stop losses will stop you out during the day with natural fluctuations in price. But the price fluctuates so much
Yes.
during the day. When we look at our charts, we always have the, it's the HLC, which is high-low close. So it's a line, and that line going this way is all the different prices that we've seen during the day. The only one that matters is our closing line, which is that horizontal line.
Yes.
And so with an automatic stop loss, if you at any point during the day on this vertical line drop below what your stop loss is, you're going to lose out on the stock.
Out.
Yeah. And you don't want that to happen because chances are it closed above that and it's safe.
Yes.
So with the manual, you can keep track of that. You can check your investment throughout the day and look at the very end of the day before the stock market closes at 4 p.m. And if it's time to stop out, it's time to stop out. If it's not, keep writing it out.
Yes. The other thing with automatic stop losses that I don't want to interrupt you here,
No,
but that we
it.
do kind of think along the lines of here is that you do have, of course, the institutional investors on the other side of this. So Leah and I talk about personal investing, talk about you doing it for yourself. You don't really need a fund manager to do this kind of investing, but there are, of course, the majority of Wall Street that are trading and doing these same, picks and stocks that we're talking about is the institutional traders that they can see quite a bit more than we can. So, for example, we do have that you can set up an automatic stop loss, but that is something that's kind of public knowledge. And if it's something that's, really psychologically really strong line, for example, say the stock is $300 and you say, oh, well, I'll put it at $290. Chances are if you've gone to that arbitrary figure, someone else has done it too. And the vast majority of people kind of have these stop losses that they say they're kind of in a range. And then you can trigger something where institutional sellers will purposefully sell to drop the stock below everyone's stop loss, get rid of all the extra baggage of the people that small investors like you, and then drive the stock price back up. I mean, that is a little bit more theoretical in terms of we can't show you that they actually 100% do this, but there is evidence to prove that it's very possible and it probably has happened before. And you don't want to put your investments in the way of that kind of momentum in the stock.
It's all about those inside trades, and we want to keep you guys safe from that. So manual stop loss is a really great way to do that. And again, it's a really great way of keeping track of your finances for yourself and helping you to understand exactly where your money is going, how it's being put to use, how it's earning, how it's losing, and what you need to do to make sure that you are setting in those gains. So a couple tricks for keeping your manual stop loss: you want to keep raising it with the price as the price rises, because if your price goes up 20% and your stop loss is still 5% below your initial investment, you could lose up to 25% of your current balance. So you just want to edge that stop loss price up with the price of the stock as you start earning. Also check your investments daily. Depending on the price of the stop loss and the price of the stock that you got in on, you might want to check based on the Friday closing and look at your weekly chart. Or you might want to look at your daily. That's completely your prerogative, and it's all about how you feel most safe with your finances. But just keep updating, checking every single day as the stock market closes, just to see where you're at. And if you do drop below that stock or stop loss, you'll know immediately and be able to hop out of it. And keep track of your stop losses physically and stick to them. Don't say, oh, it's only a little bit below my stop loss. I can just wait it out and see if it rises again. No, if it hits that number, you get out immediately. If you check your emotions at the door and you stick to your stop loss, you will see gains. You just have to invest in enough stocks, because our rule here is you can lose 6 out of 10 trades and still win if you do it right, which is what our systems are all about, and all of our services that we provide teach you that. And how to do that in the most effective manner. So keeping track of them, there's a whole bunch of ways that you can do it. What really matters is that it works for you. I keep a note in my phone. I also keep it written down in my journal because I like to have that physical copy. Some people will keep it on their computer. They'll write it out by hand over and over again. As they update, I have a little scratch it out, add my new one, scratch it out, add my new one, and then I just update it to the most current one in my phone. So I have record of it in 2 places at all times. You can keep it in a planner, you can keep it on a sticky note, whatever works for you. Just make sure that you have it recorded somewhere safe and that you can always refer back to it.
Exactly, yeah.
So set reminders to keep your investments safe. This is a new habit. So you want to have reminders for adding new investments, because you need to be invested in multiple things. Remember, diversity is key. You need to have reminders to check all of your different investments. And you need to have a reminder for what your ultimate goal is, on what you want to make, how much you want to save. It can be hard to remember to check your investments because it's a new habit that you're getting into. So you can try setting an alarm or a reminder on your alarm clock or your phone. You can make a note in your planner if you're the kind of person that checks your planner every day. You can put a sticky note on your fridge or on your door somewhere that you're going to see it every day. It's, again, whatever works for you. You know yourself. You know what's going to get your attention and remind you to do this thing. Just make sure that you enact that and check it, because you don't want to forget for 3 days and check on that stock and see it have dropped way below your stop loss.
Yes, and the other thing that we're kind of not really going to set in stone rule for this is the frequency with which you do this. You can say every day. Some investors will say, don't you dare look at your investments every day because you'll just stress yourself out. Again, that's kind of your prerogative. I can't tell you to check every morning at 9:30 to check your positions. I can't tell you every afternoon at 4 to check your positions. That's up to you. If you feel secure in your positions and you feel that you're fine to wait until the Friday close, that's up to you. We can't tell you what to do, but we can remind you the ways that that frequency could be used to your advantage, and the ways that you can remind yourself when you do come upon the occasion that it's time to check in and say, okay, where can I increase my holdings, where can I help myself out here, and how can I make money at the end of the day?
Absolutely. And that's, if you're the kind of person that stresses out when you do check it every day, maybe scale back, check every Friday, and that's when you jump out or jump in.
Exactly.
Whatever is helping you stick to that no emotions rule is really what you need to do. So the next thing is choosing safe investments. Again, it's so important to diversify. You need to be invested in a traditional retirement fund or several, stocks, bonds, and even throw in some unusual investments. If you want to look at our episode that we did a couple weeks ago on unusual and interesting investments, that can be a great thing to add to your portfolio. Keep track of how much you have invested and where, and make sure to contribute consistent amounts to all the needed funds. If you're consistently investing in a specific stock or in retirement fund and watching that money grow, remember that percentage is going to keep going up. So the more you have in there as your base investment, the more money you're going to see come out of it. But you also want to keep careful track of this so you know exactly where all of your money is. Keep records, whether it's on your computer or by hand. Just make sure that you have them. And when choosing stocks especially, make sure to choose them solely based on the health of the chart, not on your personal interest in the company. This is the number one way that people get emotionally invested and end up letting those stop losses slide. So just look at the chart. We're all about the numbers. That's the way to make money on the stock market. So we have some resources for stock searches for you. These are our favorites in the office, so we use these frequently. We have Chartmill, Stock Charts, and Robinhood. So we're just going to take you through those a little bit. This is what Chartmill looks like behind me. This is just the home screen. It's a great website for preliminary searches on stocks. It's really easy to filter and see lots and lots of charts all at once. And you can just jot down the tickers and then check on them on another site. Because Chartmill, though it's great for filtering through some good options, it's not the most reliable source for absolutely up-to-date and accuracy.
Exactly.
So once you've gotten your ideas on Chartmill, which here's what it looks like to filter through, you can choose how much you want the stock to be worth. You can check on how much it's earned over the last 6 months, year, 3 years, whatever you want to look for. Usually the longer of a period you're looking for, the better. But once you have those tickers that you want to check, go to Stock Charts. Again, this is our favorite in the office. It's a really great resource for checking the accuracy of stock prices and throughout the long history. So you can see as much as 10, 20 years of this stock. You can see the whole longevity of this stock's life, whatever the stock may be. And it's a great way to save the charts so that you just have record of them. So Tayler and I in the office will keep lists of just hundreds of charts that we've been watching, waiting for them to get to the point that we want them to, or that we just think already look strong. And you can also mark them up and add your own notes, which is a really great way of telling whether it really is a strong chart or not. And once you've picked out the stocks that you want to invest in, we use Robinhood. There are lots of other sources like this where you can actually purchase your stocks. Robinhood's great because you don't have to have a minimum investment amount. It just has to be the worth of the stock that you're choosing. And again, one of many options for actually making your trades, but I really like this one because it's available on an app. So it's very easy to access and check regularly and update, and it's very, very easy to use. So once you have all of your investments, you want to make sure that you're setting goals in how much you want to make with them, how long you want it to take for you to make that amount of money. This will help you decide how many stocks you should be invested in at once, what kind of return you should be looking for per year. Make sure to set that clear goal for exactly how much you want to get and how much you want to start at too, because if you only have $100 to invest but you want to make $100,000, you're gonna have to make some very, very careful investment choices and be very, very realistic about how long it's gonna take for you to get that return. So your mantra is to stick to your stop loss with all of these. Your mantra is to stick to your initial investment numbers. Don't invest more than you have the ability to invest. And we're not going to say don't invest any more than you're willing to lose, but make sure that you are calculating for how much you're going to lose with those stop losses. You will gain it back as long as you follow the rules and then some, but just make sure that you're being very, very smart about allocating your money in the right places. And make sure to stick to your personal rules on investment amounts, increases, decreases, the kinds of investments you're making, the number of stocks that you want to be invested in, all those details. Make sure that you write down rules for yourself that can vary depending on what your needs are, and then stick to them. So it can be really easy to fall off the wagon and claim your gains early. You might see a stock surge and you're like, oh, I want to grab that before I lose it. Just raise your stop loss, leave it in there. It could surge again. Don't forget to check on your investments. It's a really easy thing to do. I've done it before, even though I have multiple reminders set up for myself. And it can be really, really easy to fail to stick to your investment plan. You might want to pull it out early for a trip. You might be afraid of that number inching close to your stop loss and want to tug it out too early. What have you. There's so many things that can get in the way, but it's all those emotions. So, but if you make your rules absolute, you'll be amazed at the rate of increase you're going to see on your investments.
For sure.
So basically, the key to investment success is to be organized.
I know, sad. I know, you heard it here first, and it's sad to hear, but it is true.
And if you do that, you're going to see your investments bring you really, really strong returns. Just follow the rules, use our sources, find your own. There's tons of sources out there that are public information. It's just they're not shared very widely.
Yes.
So if you can find those, that's what we're here for, is to help you find those. You're in good hands. So.
Yeah, definitely.
Yeah. So thank you guys so much for watching, and we'll see you next week.
Thanks for watching the latest episode of WSI TV. Be sure to visit WSITV.com, where you can subscribe for free with no contract and gain instant access to the secrets of self-made millionaires via the WSI TV Vault. So go ahead and claim this gift for free now at WSITV.com.